let's go ahead and as we kind of look at this, and this is the one from today. And the reason that I was looking at this one today was primarily because of our 4-hour. Let's go ahead and okay, and when we look at the 4-hour, the 4-hour is giving us that downward trend. We saw that move up. But let's go to the much bigger picture. And when we go to the much bigger picture, what I want to do is I want to go to the weekly chart. Because when we talk about wealth essentials, we're completely talking about bigger picture stuff. And we got to start looking for our areas where the market can start to show weakness. So let me ask you guys this. I'm going to switch right to the SPX chart instead of the ES. Hold on, let me fix that. Areas where the market can start to show weakness. So let me ask you guys this. I'm going to switch right to the SPX chart instead of the. All right, echo should be fixed now. Sorry about that, guys. I'm glad you like the cup. Appreciate it. So when I look at the SPX, this line here is the line that we have driven as our as our line in the sand. Okay. This is really that line in the sand that I talk about, that I identify as the place where we have a true inflection point, and that would be at 3,700. And the reason that I'm using that line is because that's the area where we started to see our major momentum shift. If I look at this on the daily chart, and look at this on a daily chart. Yeah, I told a couple people I would throw this one up this morning, Amit. So if I look at this on the daily chart, we can see that our daily chart is showing slightly lower highs. We see slightly lower highs right here on the daily chart, but we are seeing slightly higher lows in price. So momentum is giving me lower highs. The price is giving me higher lows. So when I look at these lower highs as well as these higher lows, combined, what does that tell me? Well, that tells me that, think about throwing a ball up in the air, right? If you throw a ball up in the air, the whole time that ball is rising, eventually that ball stops going up and starts to come back down. And if you think about that ball that starts to go up, that is slowly going up before it starts to come back down, that's what happens before it reverses. I was outside playing catch with my son this afternoon or early evening. And I was trying to show him how to get better at catching a fly ball. And I said, you've got to look for the apex. You got to look for the apex of the fly ball to then determine where it's going to come down to. And so that's what we're seeing when we see this momentum shift. Now, it doesn't always happen that way, but I will say that we're gonna look tonight at more defensive positions for our portfolio, primarily because this isn't the first time that we've seen this divergence, right? This divergence existed all through here as well. So what that means is that price can still go up on slowing momentum. No doubt about that. Price can still go up on slowing momentum, but eventually what has to happen if the momentum continues to stall? Eventually what happens? Eventually we get the reversal, right? Yeah, gravity is going to take over and momentum is going to prevail, and that's where you start to see the potential for the rollover. So that's why I'm talking about that 3,700 being the line in the sand as our inflection point for the S&P. Now, interestingly enough, is that the S&P has started it, but the NASDAQ has already started to come down. I think the NASDAQ could already be on the inflection point. And so with the NASDAQ already being beyond that inflection point, the question now becomes, what's a realistic drop for the NASDAQ to come down to? And where do I think that it can go? Well, let's go with what the definition of bear market territory would be, because it's always good to look at what bear market territory would be. Bear market territory would put us right here at 11.2. Okay? I don't need to keep the momentum on this screen. You guys can certainly see this one. Bear market territory would put us right down in here. Now, what's interesting about price coming right to this area here? Tell me what you find interesting about price coming to this area right here. Does anybody see anything? Yeah, this is a former area of resistance, which then acted as support. It's the gap and go away from this move. And so it becomes an area of demand. And that then also becomes the 20% pullback in the NASDAQ. Now, I don't know that we're going to make it that far down, but it's the origin of a prior move. It's an area where we did see some prior basing. And to me, this looks to be a good area for a price target for us to fall down into that level. Now, I don't put a tremendous amount of credence into decision making on moving averages. But I do believe that it's important that we've seen price drop below the 50, and then we use the 50 as an area of resistance. So we drop below the 50-period moving class, and then as price dropped below that 50-period moving average, we are unable to get back above it. We used it as resistance. And so now it's just kind of hovering there at a resistance point. It rejected price. So by rejecting price, now in my mind, we're at a pretty important point in the NASDAQ. If we continue to put in lower lows, and if we get below this 12.6, I think that ultimately our next stopping point's at about 12,019, where we have this area of demand, and then I think we can make it all the way down to here. S&P, so looking at the S&P, we don't quite have the same weakness. We're also still above the 20 and above the 50. So the SPX is above both the 20 and the 50 and way above the 200. So for the SPX to have a 20% decline from its high would be a lot further. There you go. So for the S&P to have a 20% decline, we have to drop down to 3,200 in the S&P. Okay? Now, it's a possibility we will get that low. I don't know that we will drop to those depths in the S&P, but I do believe that the NASDAQ looks like it's on a course to do that. Now, interestingly enough, let's take a look at the Dow Jones. So if I look at, oops, let's forget. So in the Dow, now remember this is the you got to multiply it times 100 essentially on the Dow. Fishing for dollars, is chat available on recordings? No, it is not. So you won't see the chat feature in the recordings. No. Sorry about that. That's just that's a limitation to the Zoom software that we use. But if there's something you want me to make sure that I get in there in the recording, we can always talk about it. All right. So the Dow Jones area has really been a leader, well above its 20, has not fallen off near as much, and there's much more strength coming from the Dow. So why is there more strength in the Dow than there is in the S&P and that there is in the NASDAQ? Well, I think that's going to come down to the makeup of the indices, right? When I look at when I go to, I'm just going to go to FinViz, and when I go to FinViz and I look at the makeup of the S&P 500, here is a heat map of the S&P 500. See if I can't get this a bit smaller. For some reason, it's not all fitting on one page, and it won't get any smaller for me. There we go. All right, now I got it all on one page. What are my 5 largest stocks in the S&P? What are my 5 largest stocks in the S&P? Yeah, they're the FANG stocks, right? Facebook, Amazon, Apple, FAMG, Microsoft, and Google. So not quite FANG, FAMG. Microsoft is one of the biggies, but Apple is the biggest by a lot. Okay. I didn't know Thinkorswim had that under all 4 under the Market Watch tab. So I actually was going to pull up a NASDAQ one while you're talking, so I guess I can just go find it. So let's go look at. Let's see. Where would that be? Under Visualize? Oh, beautiful. Look at you. Trent, I love you more and more each day. I know that sounds awkward. So when I look at the Dow Jones, Apple and Microsoft are still the biggest in the Dow Jones as well. But as a percentage of the full Dow, they're not quite as big of a percentage as the full Dow. Look at the NASDAQ. 1, 2, 3. Google is basically both of these, right? So 1, 2, 3, 4, 5, 6 stocks make up about half of the NASDAQ 100, right? They make up about half of the NASDAQ 100. And that's where we're seeing our weakness. We're seeing our weakness come in some of these technology stocks that have been leaders, right? That have been really the top performing of all of the sectors. So when I go and I look at my 4 major markets together, and I'm going to look over the last, let's do over the last 90 days. Now, why am I doing the last 90 days? Essentially, that's the last quarter, right? Essentially, the last 90 days would be the last quarter. And so I'm up 8% in the Nasdaq, 10% in the Dow, 23% in the Russell, and 9% in the S&P. But let's take a look at the last month. So switching to the last month, we're seeing the Nasdaq is down 2, the Russell's down 4, the S&P's up 0.2, and the Dow is up 2.6. What does this picture tell you? When the Russell is the leader, followed by the Nasdaq, followed by the S&P, followed by the Dow, what is that a picture of? The parents will chase the kids, right? That's a picture of a market that typically is going to stay in continuation. And the kids have already started to run to the bear cage, right? If we're at the zoo, the kids are running to the bull cage. They're not running to the bear pen. They're not running to the bull pen. They're running to the bear cage. And if the kids start running to the bear cage, what are mom and dad going to do? They're going to tail along. Okay, so they're going to party. Well, I will tell you, my wife and I just might do that. No, they're going to run. They're going to run and follow them. And so, if I think that the S&P and the Dow are going to follow the Nasdaq and the Russell, I now switch my overall portfolio positioning from bullish to, at the very least, bullish under pressure. Right? At the very least, bullish under pressure, but could even go with a bit of a bearish sentiment at this time. I think it's fine to go with a bit of a bearish sentiment at this time. So our markets right now, from a big picture perspective, on a daily chart, technically, we are still in a bit of an uptrend, no doubt, on a daily time period. But is that uptrend under pressure? You bet it is, right? There's a lot of weakness in that uptrend. So I think that it actually serves you, might behoove us a bit to look at our model portfolio and say, what are some positions that we can put on that will essentially act as a hedge against our bullish positions, right? That's what we're going to take a look at tonight, is what are some of the ones that can look as a hedge for our bullish positions. So does that make sense to everybody? Any questions on that? This is your time to ask questions. The floor is yours. If you want to even unmute your microphone, please feel free to do so. But that's what I'm looking at from a big picture perspective. We are sitting right at what I believe is a true inflection point in the NASDAQ right now. And I think that the S&P is sitting just above a very, very key line of support at 3750. That to me is the key line in the sand for those markets. The NASDAQ's already coming down, right? So let's talk about our model portfolio. Now remember, our model portfolio is simply designed for you guys to have something to follow, but you ultimately still want to make your own decisions, okay? You ultimately still want to make your own decisions based upon your personal risk tolerance. So in our model portfolio, this is the one, I think Corey updated this 2 weeks ago, right? Corey went through and took a look at what are our opportunities from a couple of positions um, that we might be able to kind of still have and still set up and still use. So one of those positions that we had taken a look at last week or last month, our last month position, CLOU was a very clear stop out. VXX, some of you actually didn't do the roll down and out on VXX, and you decided you wanted to take on the position. Some of you are in VXX. So what, Fury, what price did you get into VXX? You're long the stock, right? Got in at 14. Okay, good. So that was the $14 option to get in at 14. So let's go look and see what's VXX looking like if the market comes down. Now, we would anticipate that it acts a little bit as a hedge. I'm a little bit surprised, frankly, that the VXX has not given us much more of a pop in this position. I really would anticipate that the VXX would give us a bit of a pop out of that area. Now, when you got into the 14s, did you sell the 15 covered call or the 14 covered call? Okay, so let's look at in the VXX if you're in the position, and then if you're not in it, does it make sense to set up an acquisition price for it? So if you're in the position, the 15 covered call is still paying you 55 cents, right? Now, is that going to be enough? Well, if I bought it at 14 and I sell it at 15, does that achieve my goal for the month? Well, it would be $1.50. That'd be over a 10% rate of return. So the VXX is traditionally linked to the S&P. But remember, it's not going to exactly mirror the actual VIX, right? A lot of people say, well, that's going to mirror the VIX. Not always exactly mirroring the VIX. There oftentimes are going to be slight variations on the VXX versus the VIX. But typically it should perform like the VIX does. And the VIX is sitting right at an area of support. So with the VIX sitting at an area of support, this is one opportunity and one way to hedge. Now, if you're already in it, the April 15s are still paying you 50-some cents of credit, which is actually pretty good. Well, Ariel, there won't be a VIX for RTY because remember what the VIX is. The VIX itself, let me put an indicator on here. If I put this indicator in here, so do you see how the spikes are identical in this indicator down here? If I change my chart up top to I think I can do it right here. There we go, to a line chart, what will you notice about my VIX and my implied volatility of the SPX? Now, hold on a second. Let me put the SPX on there. Okay, so here's the SPX, and still keep an eye on the implied volatility chart down there. They're essentially the same. So the VIX is the implied volatility, almost one for one. They're almost identical. So you're not going to get a VIX of the Russell because the VIX, there is no implied volatility of just the Russell, if that makes sense. All right. So what are some of the things that I can use? Well, one of them, like we talked about, is the VXX. You said Corey was trying to sell 12 call for 410, up 10% already. Okay, good. Nice. That's a good setup. Well, see, I'm okay selling. If you got it at 14, I'm okay selling the 15 because remember, my goal on our portfolio is 8 to 10%. And that's per annum. And that's over 10% in a month if you bought it at 14, sell it at 15, and get a 55-cent credit, right? Those 15s for 23 days are still giving me 55-cent credit. Now, Remember, this is 23 days, but what are we also getting inside of those 23 days? What are we always getting inside of those 23 days? We're also getting holidays, right? There's also an Easter holiday in there for us to pay attention to. So, what are some other ways that I can use as a hedge against market movements? Right? What are some other things that I can do as a hedge against market movements? Well, there's a lot of different things that we can do, and we can use inverse ETFs, right? You can utilize inverse ETFs in this kind of a situation. And so when we think about inverse ETFs, I typically go to the ETF database. I think the etfdb.com does a phenomenal job of just listing different ETFs. Now, I don't have their, what's it called, their premium membership or any of that. I really just use it for the ideas of ETFs. But if I come here and I just take a look, there are different ones that I have: commodity exposure, national resources, currency, alternatives, multi-asset, all the different ones. Well, let's go take a look at large cap assets, right? So I've got large cap assets that I have in here. So I could certainly play the ETFs themselves, or I think there's actually one just for inverse. Inverse, there we go. So inverse, uh, inverse bonds, inverse currency, inverse equity ETFs. Here we go. Now, when I look at these inverse equity ETFs, they're designed to be an inverse for exactly 1 day. They're not designed to be an inverse for over a long period. So, for example, a 3 times ultra short of the Qs means that when the Qs goes up 2%, this ultra short's going to go down 6%. When the Qs go down 2%, this ultra short should go up 6% because it's a 3 times. That 3 times is good for 1 day. The longer you stay in it, the more it's going to be more like a 2.8 or a 2.6, 2.9, 2.7. It's going to vary a little bit. But ultimately, you can utilize an inverse ETF while we are, because I know a lot of you are in IRAs that are not going to allow you to short an actual ETF. You can't short the ETF, but I can sell cash secured puts. So what might be one that's worth looking at? Well, I'm always going to first sort it by volume because I want to get the ones that have the most volume. And SDS is the Pro Shares Ultra Short of the S&P 500. Now, when I pull up the actual SDS, the first thing I'm going to do is just take a look at the options spread on a call. Now remember, why would I buy a call? Because it's an inverse ETF, and if the market goes down, if the market goes down, this goes up. So I could buy a call on one of these positions. You certainly could do that, or you sell a put in order to acquire it. Okay. Now remember, this is as a hedge position, and this is going to look, the chart is going to look terrible. It's going to look like it's going straight to the ground. Okay. When you pull up the SDS on a daily chart, it's going to look like it's going straight to the ground. Now, why would this look like it's going straight to the ground? Well, because the market itself is going straight to the sky. So what this would be is purely as a hedge against some of our other long positions. So when I look at this SDS for 23 days, I can get the 11s for 23 cents. So 23 cents on the 11s is actually not bad. I then own it at 11. Now, the interesting thing is because my delta or my beta on SDS is 2.0, what that means is that essentially I don't need as many shares to hedge some of my other positions. So if I were to come in and take a look at our Wealth Essentials portfolio, and let's look at the SDS. Okay. So SDS is currently trading for 11.25. The current price is 11.25. So that's our price at entry. And we've got, how much capital do we currently have allocated in this model portfolio? 23,000. So if I allocate about 8 grand to this position, that means I can do 711 shares. So you could theoretically sell I don't know about all in, Ariel. I don't know about all in. Um, you could do 7 contracts. Now, it might be a little bit steeper than where you want to go, but remember, you're getting it in at a slightly better price at those 11s. Okay. Now, this is not long-term protection, but what it is it's acting as a pure hedge. And if the market starts to go back up, do I ever wind up buying this security? Nope, I don't buy this security. If the market starts to go back up, I don't wind up buying the security. And my other positions continue to go up in value, right? Continue to gain in value. XOP, EEM, FXI, they'll continue to rally up in value. Now, we're down a little bit in SLV. We're down an XOP. I mean, all of these are down a bit, and so I think that SDS might act as a pretty good hedge to put us in a better position. Does that make sense to everybody? Questions on that? Okay. So now, what would our stop be on something like this? Well, in my mind, your stop on this is going to have to be below that low of 1075. And so I would probably say you're going to have a fairly wide stop on this at about 10. Right? So you're giving yourself a stop of 10 on that position. So selling the 11s for 416 expiration. That's bringing in a 23-cent credit. Now, that number very well could change tomorrow, but we'll see what's bringing in about a 23-cent credit, which brings in a pretty nice, it'll be our largest return position of the month on a pure put gathering perspective. But we could wind up owning a couple of these securities, right? So remember, we don't sell something that we don't mind owning, and where we would mind to own this, where we would want to own this would be at a position where I'm willing to be a long buyer. Okay, does that make sense to everybody? So I think that to me is probably the best hedge that we can put in for right now as our next best position. Once again, you may not be comfortable with that amount of risk because it is more risky to utilize a leveraged ETF, right? But we're utilizing a leveraged ETF to act as a hedge against our other positions. And especially with the price as low as it is, it allows me to get a few more shares. And if we see a major market sell-off, then we should see a spike in the value of the SDS. Yeah, I mean, it is on sale now. By the way, it's on sale because the market's has been going straight up. The only reason we're doing this is because of our anticipation that the market could be. Now, by the way, it's not there yet. The market is not at the inflection point yet. We are a bit premature in this order entry, but we're doing it as a hedge against our other positions. Edwin, I can download this portfolio and I'll throw it in the chat box so you guys all have a copy of it. It's available on the website. You guys can see it on the website, but I'll download a copy of it so that you guys can have it. So, all right. But does that make sense? Any questions on this? Going once? Going twice? All right. And that gives us, how much do we now have allocated in our portfolio position? So now we've got 30,950 allocated. So technically you still have 20 grand to work with in the portfolio if you want to do more of a hedge and take advantage of another movement. So I'm going to leave this one out for now. I'm not going to add another position because I think this adds enough. But we may even be willing to go out to May with some of these positions. Now, let's say we're in one of these positions that we are not in love with anymore. Okay. So for example, we sold the 2250s on SLV, and we sold that for 37 cents. We sold the 2250s for 37 cents. If I'm not in love with it anymore, current price is 23.24. So I'm still not to the point yet where I would own it, right? At 79.46, we sold the 71s. 51.68, we sold the 50s. 45.11, we sold the 44s. So am I yet in a position where I'm going to have ownership on any of these positions? Right? No true areas yet where we would have to have ownership on any of these positions based upon the current price of the security and the strike that was sold. But what if we start coming back down into that area, right? What if we start coming back down into that area? So what I want to do is talk about how do I roll that? How do I change that position? Now, I'm not ready to do it yet, but I at least want to show you what rolling down and out, what the adjustment looks like in these positions as if we were going to do it today. Does that make sense to everybody? So Ariel says, Chuck, what about buying a put on SDS? Now remember this is an inverse position. So if you buy a put on SDS, how does SDS lose value? Very good. Sorry, buying a call. You very well could. I'm glad you, because Ariel, I think I remember when I first started trading, one of the biggest losses I ever had was because I thought the market was going to go down, so I bought a put on SDS. So, been there, done that. Negative times a negative equals a positive, right? And so when you could certainly just buy a call on SDS if you so choose. That is definitely an opportunity to be there. Oh, I have too many analogies. All right. So when I'm looking at maybe I want to change one of these positions. How do I adjust it? So we're going to use SLV as our example right now. So we sold the 2250s in SLV for our model portfolio. And looking at SLV, if we sold the 2250s, I mean, we are sitting right at our demand area, right? Right at our demand area. So if price breaks below here, I think there's a really good chance that we're going to have to roll this position down and out. So what does rolling a position down and out mean? Well, I'm going to turn on my annotate tab here for a minute. And literally, if you think about it from drawing a picture, it should make more sense. I know I have. There it is. Okay. So our current expiration day is April 16th. Let me draw the line on April 16th. So that day is our current expiration date. Make that nice and thick. That's our current expiration date. Our current strike price is $22.50. What that means is that if the price is at $22.50 or below on expiration, then that is where we will be obligated to buy the security, right? At $22.50 on expiration, we'll be obligated to buy the security. So what does rolling something down and out mean? Well, when we roll something down and out, what we mean is that we roll it down. So we take, now you don't have to roll it down and out. You could just roll it down. Meaning I have the Aprils and I sell the Aprils again, but I roll it down. So instead of selling the 2250s, I sell the 2150s. But when we roll it down and out, what we do is we say, you know what? I rolled it down to the 2150s. Now I'm going to roll it out to the May expiration. So when we roll something down and out, what we're doing is we're saying, okay, now 2150 is my new number. Now let's go look at 2150. So if I go in here to the SLV, if I go into SLV, when we got into this position, we sold it for 37 cents. The 2250s for 37 cents. Well, the 2250s currently are trading for 22 cents. Oops. Currently they're trading for 22 cents. So we could theoretically close it out for a profit right now. Now, if we close it out right now for a profit, what would our profit be? We sold it for 37, we buy it back for 23, excuse me. Sold it for 37, buy it back for 23, we've got a 14-cent profit. Everybody good with that? Now, rolling the position means that in the same transaction, when I buy the 23s, that I buy the 23s to close my other position. And at the same time, I'm going to go out to May and go to the 21s. And let's sell the 2150s. So now, in this case, what I'm doing is, remember, I'm on 22. Oh, thank you. That's better. 20. That's actually better because I don't really want to buy it back for a profit. I want to buy it back as close as I can to a break even. So in this case, if I sold it for 37 cents, I buy it back for 35 cents. I still make 2 cents. Whatever, it's 2 cents. But now what I can do is I can say, well, I'm going to buy back the 35s. I'm going to buy back the 2250s for 35 cents. And then I'm going to sell the 2150s for 38 cents. Now, when I do this, what am I going to get in my account in this case? What am I going to get in my account in this case? You'd look at this and you'd say, well, it's a 3-cent credit. Well, not really. Now, I can do it as a 3-cent credit and just put them all together, right? But if I close, if I sell to close this position, if I buy to close this position for 35 cents, now I've got the 2-cent credit. And then I sell to open the 2150s for 38 cents. Now I have a 38-cent credit. So in reality, what I'm getting is a 40-cent credit on this position. Now, I'm getting a 40-cent credit on this position essentially because I'm getting a 2-cent profit on the other one, and that's a realized gain, and then the other 38 cents is non-realized. Does that make sense to everybody? Now, are we ready to do that yet with SLV? I don't know that we're quite ready to do that yet. Although I will tell you, the futures markets of silver are not giving me a whole hell of a lot of hope. So it might make sense for us to do that. It might make sense for us to roll this thing down and out to the Mays. So I'm gonna look into that tomorrow, and we may roll this down and out tomorrow into the Mays, just to be on the safe side. Because we're not in the ownership position as of yet, but I really, I mean, what when you look at this silver position, what does it look like it's setting up for? What does the futures contract of silver look like it's setting up for really, really well? Right? I mean, that's a breakdown. That's a classic breakdown setup. Okay? That's a classic breakdown. Let's see. Kelly says, did you just show how to roll down, or did you go further out to the next expiration as well? I did. I went further out to the next expiration as well. We're rolling down and out. That's the and out part, right? Rolling down is lowering our strike price. Rolling out is our time. That's why we talk about down and out. Okay. Question on the chat: when buying a call in the inverse of the ETF, do I lose money when I buy a long call because of volatility? You will. If the volatility of that option goes down and you buy during high vol and then you sell during low vol, then absolutely you would. Yeah, Deddy, in this case, the blast all would fill the orders at the same time. In reality, what you'd want to do is you'd want to create a rolling order. You'd want to close the first one and then do the second order. Yeah, Kevin, lower strike in the next expiration. Now, I will say this. In this case, I'm able to do one contract for one contract. If you let the thing get too far away from you, you're going to have to roll down and out. You might have to go further out in order to stay one contract for one contract, or you might be able to go further down, but instead of doing one contract, you got to do two. And so it will oftentimes require you to increase the amount. Well, a good question. When should we decide for a roll down and out? I think you decide on a down and out roll when the charts tell you that this thing could fall apart, right? Now, you could certainly do it at your stop loss point, but I believe it's okay to do it a little bit before the stop loss point. It'd be great to hear Corey's thoughts on this as well, although he's not here tonight. You can do it a little bit before we hit the actual stop loss point. This stop loss point is, okay, I'm washing my hands of it. I'm buying back my option, right? That's what that stop loss point is. XOP was up at 89. We sold the 71s. That's far away. Well, the current there's 71s. The current price is 79, so it's come down pretty hard. We should still be okay overall. But looking at that one, it's coming kind of close to the range. And that's really where, yeah, let's take a look at it. Right? So this is another one that on the daily chart is this one that makes sense to roll it down and out. Well, it might make more sense to own it at the 70s at this point, right? So if you think that it's going to keep falling, which is certainly what it might look like it could do, maybe I can roll it down and out. So we sold it for 64 cents, right? Sold it for 64 cents. And those are that's the 71. So the 71 for 64 cents. To buy back that, now, to buy back that 71, which sold for 64 cents, is going to cost you $1.20, right? So now, what does that mean? Well, that means I'm down 60 cents in the position. So now, what do I do? If I sold the 71s and I don't, now, by the way, 71, it still may not be a bad place to own it, right? We still have 71 as a good place to own it. But if you want to buy it back, you sold it for 64, you buy it back for $1.20, you're now down 60 some cents in the position. Well, does that mean that I have to sell it for more than $1.20? Well, in reality, if I go down and out, so let's go down from April to May. If I go to May, I can sell the 65s for $1.31. Right? So I buy it back for $1.20. I sell the 65s for $1.31. Now my cost. So what does that do to my ultimate risk? What does that do to my ultimate level of risk? If you think about that, you lower your risk. Why do you lower your risk when you do that? As long as you keep the same number of contracts, why do you lower your risk? Why does it reduce your risk? So Edwin says getting more credit than what was lost. Absolutely. First of all, you're getting more credit than what was lost meaning that you keep your original credit essentially, plus the difference between what you buy it back for and what you sell the next one for. That's a plus. The other advantage to that, when you look at it, is that you now can your cost basis has gone from 71 to 65. So if you have to buy the stock, you've just cut your cost basis down by $6. So you've cut your cost basis by 8%. That's an 8% savings on the purchase of the security if you need to get it. Now, what happens if price starts to get closer to those 65s and you say, I don't really want to own it at 65 in May? What can you then do? You roll it down and out again. And every time you roll it down and out, as long as you stay with the same number of contracts, what are you doing to your risk? You're lowering your risk. So what we're looking at tonight is, okay, we've got some positions that could get hairy. First of all, we hedge it utilizing an inverse ETF and potentially owning an inverse ETF to hedge some of those long positions. Second thing that we do is we utilize rolling down and out as a way to move the loss forward so that we don't have to take it. And now, if you wait until after the price has fallen too much, it doesn't work. So you've got to really be keeping an eye on these positions to understand, okay, when is that going to happen? Now, when I say really keep an eye, I think once a week is probably still going to be okay, right? Which is why we use ETFs. But I think that rolling these positions down and out is probably going to be the best way to protect yourself in those. And then you're looking at a cost basis of owning it down here. Who would be willing to own it down here? What do y'all think? Is that a place where you might be willing to own it? Heck yeah. Right? Heck yeah. So I'm going to take a look at those tomorrow, and we'll see kind of what those positions look like, and maybe I'll throw out a short video if we decide to make some of those changes. When is the best time to roll? When you feel like, I think this thing can go lower, and I have a chance to own it at a lower price. So actually, right now is a good time to roll some of these positions. Okay. Yeah, so I'll look to see what these look like tomorrow. Maybe there's something that we can do as far as rolling these and putting them into a better positions. First trigger sequence is fine. Trent, I actually think it's fine. In reality, just to make sure that you don't have any errors, it's actually probably better just to create a closing order on the existing put to buy back that put for a small loss, sometimes a small loss, sometimes a gain, and then sell the other one as a completely separate transaction. Yeah. All right, everybody. Well, I think that's all I have for tonight. I know we typically go the full hour, but I don't want to belabor the point. I feel like this was a good topic and a good area of discussion today. I appreciate you guys more than you ever know. Thanks for joining us this evening. I'll be back tomorrow with our strategic trader live trading room. So we will look at some individual stocks. If you guys have some stocks you want to look at, I want you guys to send some to me tomorrow morning in the chat window. But we'll start that tomorrow morning, 7 o'clock Central. Peace out, everybody. Have a good night.